Welcome to Money Growth. Today, SpaceX went public, and the bigger it runs in the next few weeks, the more shares get dumped on you. You see, SpaceX engineered today's pop to work against you. I know that sounds dramatic, so let me earn it. Somewhere in Manhattan right now, a group of bankers is watching the stock trade. Every tick higher, they smile a little wider. Not because they own the stock, but because there is a clause in the lockup agreement they helped write. And the higher the price goes, the sooner that clause triggers. The pop everyone is celebrating today isn't a celebration. It is a countdown. Before I go any further, let me say what this video is and what it isn't. This isn't a video about SpaceX being a bad company. By almost any measure, it is an extraordinary one. It launches more rockets than entire nations. Starlink alone serves more than 10 million customers in over 150 countries. The defense contract pipeline runs deep. So if you came here looking for someone to tell you the rockets won't fly, that's not what this is. This is about the difference between a great company and a deal structured to favor everyone except the person buying today. Those are not the same thing, and the gap between them is exactly where ordinary investors lose money on deals like this one. What I am going to show you over the next few minutes lives in a public document. It is printed in the Prospectus SpaceX filed with the SEC. Anyone can read it, and yet almost none of the coverage you have seen today has touched it. SpaceX is going public at a valuation of about $1.75 trillion, against last year's revenue of roughly $18.7 billion. That is somewhere near $94 of valuation for every single dollar of sales. 94 to 1 for a company that is currently losing money. To give you a sense of how stretched that is, one of the most respected independent research firms on Wall Street ran its own detailed valuation of SpaceX and concluded the company is worth closer to $780 billion. That is more than half below the price it is going public at. The valuation already assumes the future has arrived. Let me build this from the ground up. When a company goes public, only a small slice of its shares actually start trading on day one. In SpaceX's case, that slice is about 5% of the company. The other 95% is still held by the people who got there first, the founders, the employees, and the venture firms that funded SpaceX over the years. Those insiders aren't allowed to sell yet. They are contractually locked up. The reason is simple. If everyone who owned cheap shares could dump them on day one, the supply would crash the price instantly. So almost every big IPO uses what's called a lockup period, usually 180 days, to hold that supply back. But here is where SpaceX did something completely unusual. Instead of one cliff at the end of 180 days, SpaceX built a staggered release schedule. 5 separate tranches that unlock at fixed intervals, 2 additional cliffs tied to earnings reports, and 1 performance trigger tied to the share price itself. That last part is what the headlines aren't covering. The prospectus says if the stock trades 30% above its IPO price for 5 out of any 10 consecutive trading days before the first quarterly earnings report, an additional 10% of insider shares unlock for sale early. The IPO price is $135. 30% above that is $175.50. The futures market before today was already sitting around $155, so the trigger isn't theoretical. One good week is all it takes. This clause does something most retail investors will never notice. It turns the day one pop into the starting gun for early insider selling. The harder the stock runs in the first few weeks, the faster locked up insider shares become free to sell. The pop isn't a victory lap, it is the trigger. Let's look at the calendar. Today is day 0. Fast forward to day 70, the first staggered tranche unlocks. 7% of insider shares become eligible for sale. Then day 90, another 7%. Day 105, another 7%. Day 120, and day 135. That is 35% of insider shares released across 5 dates between late August and late October. And those are just the time-based unlocks. 2 more massive cliffs land somewhere in between them, tied to the company's earnings reports. The first cliff fires 2 days after SpaceX reports its first quarterly earnings, releasing another 20%. The second cliff fires 2 days after the Q3 report, unlocking another 28%. By the time we hit the standard 180-day mark on December 9th, a massive 83% of insider shares will have already been released before the calendar even hits the usual expiration date. Why would SpaceX design a lockup like this? Why not just use the standard 180-day cliff? The answer is that this schedule was built to do 3 specific things. First, it avoids the massive cliff drop. When Palantir's lockup expired, the stock fell 13% in a single session as insiders sold tens of millions of shares. When Rivian's lockup expired, it dropped 20% in a single day. Cliffs are brutal and they make headlines. A staggered schedule diffuses that selling pressure across a dozen smaller dates that nobody outside the prospectus is going to track. Second, it accelerates float growth. The faster the float climbs from that initial 5%, the higher SpaceX qualifies to be weighted in major stock market indexes, especially the NASDAQ 100. Under new rules, companies can be added to the NASDAQ 100 in just 15 trading days. And for companies with a free float below 20%, the index treats their float as if it were 3 times bigger. This means SpaceX's tiny slice of trading shares pulls a massive gravitational weight in the index. The heavier the weighting, the more forced buying pours in from passive funds that track the NASDAQ. So every tranche that unlocks isn't just releasing supply for insiders to sell, it is also clearing the path for billions of dollars of institutional buying to flood in and absorb it. That is a feature, not an accident. Third, it gives insiders predictable exit windows. While retail buyers are reacting to hype, the early employees and venture firms know exactly when they can convert their paper gains into actual money. They have lockup partners, fund timelines, and clients waiting on returns. They need to sell. And this deal lines up perfectly for them. The person at the very top, Elon Musk, committed to a 366-day lockup. He holds majority voting power, and his net worth doesn't depend on immediate liquidity. He gets the credit for staying locked, while the early employees and venture funds get multiple timing windows to cash out. So, where does that leave you if you are genuinely drawn to this company? Watching everything I just laid out is not the same thing as saying you should never touch SpaceX. There is a smarter path than the 2 loud options. The first loud option is to chase the hype. Buy today at the popped price right before the trigger window opens, and become the exit liquidity for insiders who got in early. The second loud option is to write off the whole thing forever on principle, throwing out a genuinely remarkable business just because the day one deal structure was unfair. The third path is quieter, and it costs you nothing but patience. You let the calendar do the work that hype is trying to rush you past. 6 months from now, every restriction on the staggered schedule will have lifted. The earnings reports will have landed, putting real financial numbers on the record. The performance trigger window will have closed, one way or the other. The forced institutional buying from passive funds will have run its course. Every one of those events is a piece of real information replacing speculation. It just requires you to not be in a hurry. The best companies of the last few decades stayed viable for years after their IPOs. You did not have to own them on day one to do extraordinarily well. The market rewards the patient far more reliably than it rewards the early. The thing being sold to you today as a once-in-a-lifetime, act-now moment is almost always a stock that will still be there next quarter, and the quarter after that, at a price set by reality instead of a countdown clock. Let the insiders take their exits. Let the hype fade. And when the dust settles in 6 months, you can make your move. Thanks for watching. If this saved you from being Wall Street's exit liquidity, hit that subscribe button and...
Unlocking your financial potential is easier than you think. With the right strategy, your savings can truly grow. We reveal proven paths to consistent wealth growth.